ahead and get started. We've got
Okay.
Chad Mills missing and Secretary Johnson. I think in this.
Okay, no, that would be great. We'll just, it's about 2:05, so we can honor everybody's time by getting going and keep things moving so we can stay warm. So I'll call this meeting to order. Sam, do we have a confirmation of the quorum?
Yes, we have a quorum and the press have been notified.
Awesome. So I'll jump into our section B here, and I apologize, I just lost the screen.
Next up is the minutes.
Okay.
I will.
Has everybody reviewed the minutes from our last meeting? And do we have any discussion on that?
I'll make a motion to approve them.
Second.
Okay. We have a second. So all those in favor?
Aye.
Those opposed with a like sign? Motion passes. So I will, and I apologize, I just happened to lose the screen just for a few moments. So I think we're going into section C, whatever that is, and I will try and catch up here.
Sorry,
Love having technical difficulties.
We're good. That's me. Thank you, Mr. Chairman.
Thanks,
Good afternoon, everyone. I'm going to be going through the second quarter financials as well as some highlights of our mortgage and servicing operations. So we will start here with the balance sheet. Are you all hearing an echo?
I think if everybody mutes.
Yeah, if everybody can mute, that should help. Okay. There's still an echo. Okay, I think we're good. All right, so I'm going to start here with the balance sheet. We'll start with line A. Total assets. Sam, is there any way we can mute everybody?
I just did.
Okay. All right, perfect. Thank you so much. All right, let's start over. So we're going to start with the balance sheet here, starting with line A, total assets. This continues to increase. Story we've had for the last 2.5 years. It increases as a result of us issuing mortgage revenue bonds to finance our mortgage activity. So our total program purpose assets increased by $128 million since June 30. And that is mostly the mortgage-backed securities being purchased into the new indenture. Line B, cash and investments. This decreased by $64 million. This includes a $53 million decrease in investment securities and $11 million decrease in cash. This is mostly primarily in the new indenture as we utilize bond proceeds we had on hand to finance mortgage activity in the first half of the year. So overall, assets increased $63 million since June 30, down in line D. Going down to lines E and F, revenue, bonds, and interest payable. These two lines increased by $55 million during the first 2 quarters. This is mostly a small bond issuance of $75 million in October, and that is offset by our July 1 bond redemptions and our payments to the bondholders. Looking down at the net position before our mark-to-market in line J, it increased by $11 million for the first 6 months, and this just reflects a nice profit and the net interest income over the first half of the year. Going down to line K, this is our mark-to-market of our securities as required by GASB. The market value of the securities improved for the first 6 months of the year by $13 million. This is the trend we saw last year. This is mostly the securities in the new indenture. And we continue to add more securities to the indenture. Most of the securities in our old indenture and some of the general fund are sitting with unrealized losses. We don't plan to sell them, so it's a non-cash adjustment to the books, but we continue to watch this mark-to-market. At some point, it will come down, which will have a negative impact on the books. And then going to line L, the overall net position for the year improved by $24 million to $528 million, mostly the result of booking the mark-to-market and a nice profit 6 months in. Any questions on the balance sheet? All right, moving on to the income statement. Just a couple things to highlight here. Looking at line C, net interest income. It's pretty even year over year. We still got a nice margin there. Going down to line D, gain on sale of loans. We increased for the first time in a bit year over year by a little under $1 million. TBA prices have been improved slightly as we've slowly been decreasing our rates, but it's certainly been a challenge to manage and stay profitable, but we're still continuing to have some success there. Fees, charges, grants, and other income in line E increased by about 1.8 million year over year. This is mostly a result of our servicing income and multifamily fees being slightly ahead of where they were last year at this time. And you'll see that when we go over the operating budget results as well. And then line F, similar to the last slide, this is an increase in our mark-to-market. We saw a big pickup in fiscal 26 of 13 million. Again, we continue to add more securities to the indenture with an unrealized gain booked. Line G, total revenues increased by 10 million, which is largely that non-cash mark-to-market. And then going down to line H, G&A expenses, they're an increase of about 1.5 million. This is predominantly increased servicing default costs. Again, you'll see that in the operating budget and some other general operating expenses. Line P, change in net position, which is the net income for the year, is 24 million, an $8.8 million increase compared to last year. Again, this is mostly due to the pickup of the fair value of securities at December 31st last year compared to this year. If you go down to line U, the true cash pickup is 1.4 million when you take the mark-to-market out of the math. Any questions on that schedule? You move on to cash flows. Not much to point out here. If you look at the bottom of the page, if you look at the bottom of the page, you can see our production is pretty level last year at this time compared to this year. Again, you'll see on a future servicing and mortgage production slide, our total production is at 305 million for the first half of the year. So we're still cruising ahead. The next two slides are related to our operating budget. So this first slide is the operating fee income budget versus actual report. I'll just go through a couple of the variances on here. Line A, rental assistance, we're 235,000 in favor of the budget on the fee income associated with that program. We've received a higher PBCA fee than we budgeted, and we're also continuing to receive an emergency housing voucher fee that we did not budget to receive in fiscal 26. So I'm happy to see that there. Line C, homeless grant programs. This is unfavorable to budget by 430,000. This is really a result of the lower expenditures in these grant programs. Due to the government shutdown, programs were managed a bit more conservatively to ensure they could carry out through the rest of the fiscal year in the event of like a longer shutdown or a cut in funding. So the larger variance is mostly seen in the COC connector grant. Housing connectors have been charging their time to home ARPA, which is up in line B, which explains that positive variance there, rather than in the COC grants. So when we don't have the expenditure, we don't have the grant income to draw down. So that's where that variance comes from. Similarly, in line D, weatherization programs, unfavorable to budget by 372,000. This is a result of some staff vacancies and just lower expenditures in that area. So if we didn't incur the expense, we don't have the associated fee income. Line F, COVID programs. You're going to hear me cover this a couple times this year. Unfavorable to budget by 602,000. When we made the budget for fiscal 26, we planned to have the HOPE program, our foreclosure prevention program, wind down later in the year, only to determine about last summer that funds would be exhausted sooner than planned. So we've already shrunk our staff size, the program sunsetting. So you're going to continue to see less expenses in that area and less admin reimbursement in that area. Going on to line G, mortgage servicing fee income is $703,000, favorable to budget. We always try to be a little bit conservative with this income projection, as it depends on loans not prepaying and a performing portfolio. Happy to say we have both of those. But again, it's generally a conservative estimate, not knowing where the market's going to go. Line H, rental production, is showing 778 million favorable to budget. This 778,000 favorable to budget, I wish it was million. This variance is mostly due to the timing of projects closing. We did have a big push for a handful of projects in December that had expiring bond cap to close. There's also some additional revenue from our inspectors taking on some third-party inspections for our partners. So go down to the bottom of line P. We are about 1.8 million favorable to budget with a surplus of 4.5 million halfway through the fiscal year. So performing as planned, a little bit ahead of the plan. Any questions on that schedule? All right, this last financial schedule is the operating expenditures budget versus actual for 12/31. Starting with line F, business services, we're favorable to budget by 225,000. Some of this is related to the cost of a new website, a project that's been in the works, but has been pushed further into the fiscal year. There's also no or less expenses associated with a HOPE program that were budgeted for under business services that we will not see. Line G, mortgage servicing default costs, is unfavorable to budget by 263,000. I know I spoke about this when we provided the first quarter update in December. We've seen increased default costs as a result of a couple things. There's been a change in the loss mitigation rules. So there was a lot of different options for borrowers during COVID, which has since changed to more pre-COVID rules. So you can only have your mortgage modified once a year now. There's a payment plan you need to be on for a certain period of time. So that's driving up some of the costs as borrowers could potentially go to foreclosure status sooner than they were during COVID. The HUD allowable fees that can be charged for property preservation and court costs have also increased, adding to this variance. Additionally, there was an anomaly in the first quarter where we were working on purging files and you needed to zero out some old foreclosure charges in borrower files. So that is a one-time expense that we won't see going forward. Line H, employee development, is 125,000 favorable to budget. This is related to a slowdown in our homeless programs during the government shutdown, as well as some of the availability of conferences and trainings. Line J, training for partners and clients. This is favorable budget by 110,000. This is associated with a contract with Home ARPA, which looks like it will be utilized more so in the third and fourth quarter. Line O, liquidation shortfall, unfavorable budget by 71,000. There's a handful of things like the default costs affecting this number. When a loan is paid in full, we're allowed to charge the borrower the interest to the date of the payoff, but we have to pay that full month of interest to the shareholder. So the timing of the payoff plays a role here. We also have larger loans and a larger portfolio. So definitely things to be considered as we've started budgeting for next year. Line T, equipment and furniture, unfavorable budget by 70,000. This is a break room project we had planned for the fall that's been pushed back to looks like April of this year. But overall, we're still on budget. We're ahead on revenues. It's been a good first half of the fiscal year. Staff are always very mindful of their budgets. So pretty good report so far this fiscal year, Mr. Chairman. Any questions on the financial update?
Good job, as always, Tracy.
Mm-hmm.
You laid it out really well. Does the committee have any
Thank you.
questions for Tracy at this point?
Okay, just got a couple more reports to run through. Sam, if you could scroll to a black and red chart. Thank you. I think that's just a good historical reference of where we've been with our mortgage production. Laura, do you think you could try to mute everybody again? All right, I think we're okay. So this chart reflects our total outstanding bonds in black compared to our total servicing portfolio in red. As you can see, from 2009 to June 2023, the total outstanding bonds decreased to about 155 million outstanding, while the servicing portfolio continued to grow. At that point, we made the transition to start issuing bonds again to finance our mortgages. So you can see the black line increase, where we now have almost 800 million outstanding in bonds. Again, I think it kind of introduces the next couple slides on our mortgage activity and our servicing. So these next couple of pages outline our mortgage production activity and some servicing stats. Our plan for finance for mortgages this year was to issue bonds as well as offer our secondary market loan product. The next few tables will show the results of that. So starting at letter A, this provides some detail on our bond issuances over this fiscal year. We've issued 175 million in bonds, 125 million of that tax exempt, 50 million taxable, with our most recent issuance due to close this Thursday morning. Going down to letter B, this is the loan volume financed with those bond proceeds. So 6 months into the fiscal year, we financed a total of 146 million, with mortgage revenue bonds slightly down from last year at this time. The next three sections highlight our secondary market trading results. So these are the loans we sell on the secondary market, but still retain the servicing for. So starting with letter C, these are our Ginnies. We had an overall loan volume of 119 million with a overall net gain of 2.7 million, a slight increase year over year. Our Fannies in letter D, we had a loan volume of 23 million 6 months in with a net gain of 173,000. And then letter F is our Freddie. This is a product we introduced in about 2 years ago, the spring of 2024. We had a total loan volume of 16 million with a net gain of 146,000. And then finally, in letter F, the total mortgage production was 305 million. So good first half. One thing that's not on here that maybe we may want to think about looking at is, although our loan volume is on track to where it's been in prior years, we're actually serving less households. Our average cost per loan is increasing. So the loan volume is good. It's good for servicing, but we're certainly not getting as many borrowers into their first homes as we have in the past.
So Tracy, that's Bill. So F is the combination of A, B, C, D, E, or just B, C, D, E?
It should be
I mean C, D.
B, C, D, E.
B, C, D, E, right? Yeah. So it's what we did that we financed with bonds and plus what we did through the secondary market.
Correct.
And so total volume 305, and go scroll up just a minute, Sam. And what was it, 140? So about 50-50 almost.
We've been about going 50-50. Yep.
Yeah. Okay, thank you.
All right, can scroll a little bit more, Sam. All right, so this box G here, I'm going to go over a couple things servicing related. We've got a total servicing portfolio of 3.725 billion. This consists of 2.8 million serviced for others, 155 million in our old HRB indenture, and 664 million in the new single family indenture, and then 68 million in our warehouse or our housing assistance fund. You can see there the old indenture continues to shrink and the new indenture continues to grow from our recent bond issuances.
Okay, quick question, Tracy.
Mm-hmm.
I'm sorry. So have we ever sold bonds I mean, if we ever booked mortgages, whether we financed them with bonds or in the secondary market where we didn't retain the servicing?
I believe back well before myself, well before my predecessor, we did. I have to dig through some history, but we've been doing our own servicing for quite a while now. I don't know if any other deputies have a better historical knowledge of that, but I do believe that we did bring servicing back in house probably over 20 years ago.
Maybe a strategic question. I apologize if this is obvious to everybody else, and I don't know what condition would it have to exist before we wouldn't retain the servicing?
I mean, I suppose it'd be the cost of service. So, I will say, we were no longer in the state pension system, but for a while it got very, very expensive to employ staff. When we were paying 56 cents on the dollar in for every staff person, and it was close to going up to 90 cents on the dollar. It was very hard to staff anything here. So, our biggest expense is salary benefits. And if we were in a situation like that where we had to pay a significant increase in health insurance, or if we were still in the pension plan, that it might be something we would have to look at.
I would think that scale works to our favor. So the larger you get once you've got the infrastructure. I hear what you're saying, but as a general rule, once you get the infrastructure in place and the systems and the all that down, that volume is your friend.
Yeah, I think that makes a lot of sense. And I think what we're bumping up to now is we're just still kind of clunky administratively. We may have outgrown our servicing software. I think we're their biggest client. So there's room for improvement, certainly. But as we've grown to this size, yeah, we're kind of outgrowing our shoes a little bit. And we've got a servicing director you'll meet on Thursday that he is really motivated to bring us to where we need to be electronically and streamline some things better, because we do just continue to grow.
Thank you. I appreciate that. It's good background information. Thank you.
No, I appreciate the question. Scroll to the next page, Sam. Looking at letter H. Perfect. This is our weighted average servicing fee by loan type. I just want to point out the service for other, the servicing fee is 31.8 basis points, 0.5 decrease over last year. This is entirely just competing on interest rates in the TBA market. It's been a challenge, to say the least. So we're losing a bit of our servicing income, just trying to be competitive with interest rate and putting them in coupons that don't create as much servicing fee as we would like to enjoy. But we're being a little bit more mindful now, and if need be, we can shift some production over to the bond finance mortgages. But it's definitely been a difficult year to be priced as interest rates are coming down a bit. Then just looking at our delinquency ratio at 12/31, we had a delinquency ratio of 4.73%, which is down from 5.09 in 2024. Staff are doing an incredible job. We've got a big portfolio. We've got a difficult portfolio. Our borrowers are mainly first-time home buyers, low to moderate income. So staff do a really great job staying on top of folks who need to get their payments in. And then our foreclosure ratio is at 1.17%, up some from last year. Again, that speaks to what I brought up earlier, that just some of the loss mitigation strategies have changed since COVID, and borrowers don't have as many options to keep them out of foreclosure status as they had before. It's still a good number. It's still a good ratio for a portfolio our size. And we'll continue to watch that number given a lot of the economic factors are up against us. And then just a financing plan. not much change here. We're going to monitor potential refunding opportunities in the HRB indenture over the next 6 months. And then loan fundings, we're going to continue to run both programs. So both TBA and mortgage revenue bonds and see where rates go. I will be bringing another bond parameters resolution to the full board meeting on Thursday for authorization to issue up to $600 million in bonds over the next 12 months. I don't think we will come close to that, but again, we need to watch rates and make sure we're making money. So our municipal advisors suggested doing smaller bond deals more frequently over the next year to navigate any market turbulence. So just want to make sure we've got room to move within that environment. But with that, Mr. Chairman, that completes my report.
Wonderful. Does anybody on the committee have any questions for Tracy before we let her go? Well, like I say, I always want to commend her for completeness, and you laid it out very logically. So I didn't have any questions from my chair, and apparently nobody on the committee did it either. So with that, let's move on to the next category, which I believe is open. I believe it's open. I've lost all my technology, so I'm kind of flying blind here on the informational items, I believe.
Next up is informational items, yeah.
Yes. I'm having to go by memory, Sam, so help me, please.
Yeah. I'm not aware of any from staff.
There's not any that I'm aware of. I think we're saving our informational items to the next week's when we come in person.
Well, sounds great. Well, if hearing none, I'm sure that the last item up for bids is the adjournment. So I will entertain a motion.
So moved.
And I'm assuming we'll have a second somewhere.
Second.
I usually can always find a second to adjournment. And
Second.
So all in favor, say aye.
Aye.
All opposed, like sign. Motion passes. Great job, everybody. Look forward to seeing you guys on Thursday.
Thanks, everyone.
Thanks, everyone.
Appreciate it.
See you Thursday.
Thanks, guys. Appreciate the questions and